So I set this up off camera, and you can of course hit pause and set it up on your own spreadsheet and just follow along. So basically what happens here is we're gonna lease this asset. We're gonna pay $20,000 up front in order to get the ability to take this asset, kind of off the lot, right? So we're gonna pick up this asset. We've got to pay $20,000 down initially, and then we're gonna have a $15,000 annual payment for 5 years on this asset. So really there's 6 payments total. There's a down payment and then 5 $15,000 payments. It's very common to have to pay something before they let you take an asset on a lease. So first we start off with this time period 0. So time period 0, we're going to be ending up with a negative cash flow of $20,000. So I type an equal sign in cell B11, then a negative sign, and click on my $20,000 and press enter. Now, there is no tax savings with the down payment you make on a lease. So we're going to enter a 0 with the tax savings. And so our net cash flow is just going to be equal to our tax savings plus our $20,000 negative cash outflow. Now, the payments are simply going to be equal to, so in cell B13, I type an equal sign, then a negative number, and I click on the $15,000 payment and press enter. Now, the tax savings are just going to be equal to the negative of our 27% marginal tax rate, going to hit F4 to lock in the cell reference, multiplied by our $15,000 that we spent on the lease payment, and we press enter. And our net cash flow is just like it was before, so we can drag this first cell down. Let me double check my cell references to make sure I activated them here. Let's do a cell reference here. Hit F4 there. Okay. Now we just take these 3 columns right here and we just drag them down, and we get the total net cash flows or cash outflows from this process. Now what we need to do is we need to find the present value of these cash outflows. And to do that, we use the PV function. So we type equals PV, open parentheses. Our rate is our discount rate of 8%. Hit the F4 after you select cell B4 where our discount rate is at. NPER is the number of the period that we're in. In this case, it is period 0. Type a comma. We're going to leave the payment blank and type another comma so we can skip over the payment. And then the future value is going to be equal to the net cash flow in column D. So we click on D12. We will close that parentheses, we'll press enter, and we get a result of $20,000. Now I want that to be negative, so I'm going to make my payment negative here. And I hit enter. So we're going to drag that down, and it should give us a series of present values. Good. Let's move this net present value right there so it's where I need it at. And we'll do some quick formatting so our table looks a little bit nicer. Now it's simply a matter of adding up those red numbers. So we're just going to use the auto sum function. I think that's off the screen here. So I'm just going to hit the auto sum function and press enter. And I get a number. I get negative $63,000. Basically what this is saying is after I factor out the fact that I'm paying 27% income tax, and by having expenses, I'm lowering my tax bill, I end up spending a total of $63,720 in today's money on this asset that was $85,000. And what we do is we just pop over to the previous tab and we compare. So if I were to have borrowed money and made an annual payment in addition to a down payment, I would have spent $53,694 owning this asset. And there are several reasons why it works out the way that it works. The first being that there is a salvage value. If the salvage value had been 0, we would get a very different answer. And the cool thing about setting up an Excel spreadsheet like this is you can just go in and change that salvage value to 0 and press enter, and you see the two numbers are a little bit closer together. So the salvage value plays a pretty important part in what the total net present value is. And the other thing to remember is, well, first of all, there are multiple ways to set all this up. And you could have made these two look a lot more like each other than I did. I kind of put a little variation in how I set them up. This turns out to be one of the most useful things you can learn in a finance class, because when you get out there in the business world, people start pitching you ideas when they want you to buy something. Well, you can lease it, and if you lease it, you can count the lease payments as a tax deduction. Well, guess what? You can also count the depreciation when you finance it and the interest when you finance it as a tax deduction, because when you buy a thing in your business, interest is listed as an expense, and so is depreciation. So anytime you spend money on interest and depreciation, it's going to cut down the amount of money that you're making, your profit. And every time you cut your profit, you're going to save money on taxes. Which brings me around to a story I always tell when I talk about depreciation and tax savings in these types of calculations. And that's this. If your accountant comes to you and says, hey, your assets are all depreciated out, you need to go buy a new asset so you can have some tax savings. Don't do it. The correct time to replace your assets is you wait until the asset needs replacing. If the asset still functions properly, if it's still efficient, if it still operates, if it's not broken down all the time, keep running it. Because then you're not making a payment on the asset, you're not paying interest on the asset, and your asset's not depreciating. Making that payment and paying that interest and having to cover the cost of that depreciation, all of that decreases the profitability of your business. So you don't buy an asset that's functioning fine to get a tax savings. Now, if this asset's always malfunctioning, and it's worn out and you're spending a lot of money replacing parts. If this asset is out of date and no longer meeting the needs of your business and you need something newer technology, for example. And if you replace the asset, you also get some tax savings. That's just gravy. That's the way to think about it. You don't replace the asset to get the tax savings. You replace the asset when the asset needs replacing. And if you happen to pick up some tax savings in the process, that just makes the math easier to do. And that's the way to think about the tax savings that comes from these calculations that I've shown you today. That's all I have for you today. If you have another way of doing this, I've done this thing actually 2 different ways if you notice closely, and there's a million different ways to do these kind of things. And if you've got a faster or a more efficient or more accurate method for doing what we've done today, please let me know. I'd love to hear about it. Thank you all for listening, and I hope you found this helpful.